Welcome back to AllGen Academy. So today we want to talk about one of the biggest quote-unquote expenditures that we may ever incur in our lifetime, which is the home and the mortgage associated with the home. Okay, so this is going to be interesting because most people don't buy houses cash. Okay, they get a mortgage. Okay, and yes, we are anti-debt, specifically consumer debt at AllGen. But we understand that most people will have a mortgage. And how do we approach the mortgage so that we try to, even though it's allowed, okay, in a financial plan, we minimize the detrimental aspects, which is the interest that you pay over time. Because studies show, and we're going to show a little bit, that the typical mortgage, which is a 30-year mortgage, you end up paying twice the amount for the house just on the interest, okay, just because of the interest. So if you do have a trail map, we're going to pinpoint this particular section that says home ownership and mortgage payoff on how to approach a mortgage, whether you have a 30-year, 15-year, and how to accelerate that. Why it is critical. While we think it's okay to have a mortgage initially, we do also believe that accelerating the payoff of the mortgage can be hugely beneficial. Jason, talk to us about that.
Yeah, absolutely. I mean, that's how we kind of define financial freedom to one extent, is that not only have you built up enough investments to be able to fund for your financial freedom, to be able to fund your income, but at the same time, you're completely debt-free. All your consumer debt and your mortgage.
Right.
And if you can imagine that, what that feels like to be completely debt-free, I mean, there's just a level of peace, a peace of mind that you have. I mean, obviously you're saving tons of money on interest. You really don't need to save up as much to reach financial freedom because your expenses are lower.
Right.
So if you don't have to make a mortgage payment, that's less, kind of a monthly net that you need to be able to, to fund your financial freedom.
Right.
And this is if you desire, but it gives you the ability, if you want, to take a little bit more risk in your investment. So, you're kind of taught in finance that the closer you get to retirement, the more conservative you get.
Right.
And in some case, that does make sense, especially if that's your personality and you feel more conservative, or you don't like the volatility in your portfolio. But if you can imagine, if you had a lot of emergency reserves and you had your house paid for and you had no debt, you could have that ability to be a little bit more, take a little bit more risk in your portfolio and maybe allow your investments to grow a little bit more.
That's right.
And if the market takes a big hit and your investments are down, knowing that you're completely debt-free and that your expenses are lower, you're not as tempted to get scared and to pull out of your investments when they're down. And a lot of people don't think about that when they think about if they should pay off their mortgage or not.
And it's interesting because we may sound counter, intuitive or counter media or press. Oh, don't pay off your mortgage. Traditionally, they would tell you that so you can deduct the interest. Okay. I mean, I don't think we're going to get too much in depth into this, but deducting the interest means you get a percentage break on the interest you paid.
Right.
But let's say I paid $10,000 in interest, so I saved $2,000 because I did that.
Right.
Well,
you paid $10,000.
You paid 10, you saved 2, you still paid 8.
Right.
Versus if you have no interest, you saved 8.
Yeah. And
so
only about a very small percentage of the population even, it gets the deduction for their mortgage interest.
When the tax laws changed a couple of years ago, a lot of people weren't able to itemize anymore. So this whole theory about not paying off your mortgage to deduct interest is out the window with the majority of people. But let's talk about the difference between 30 versus 15 year, the impact that can have on the interest you pay.
Yeah, absolutely. So, one of the ways to kind of start to knock off your debt or pay off your mortgage quicker is to make sure you're in the right mortgage. And a lot of time, we're big believers in the kind of the shorter term mortgages, the 10 or the 15 year mortgage over a 30-year mortgage. And so let's just give an example right here with a loan amount of $275,000. As you can see right here, comparing a 15-year mortgage, which is the shorter term one right here, that's at 3% for 15 years, versus a longer term, a 30-year mortgage at 3.5%. Okay, so a lot of people think if you do the 30-year over the 15-year, the 15-year over the 30-year, you're gonna have a much higher payment. But you can see here the payments just about $1,900 versus for a 15-year versus $1,235 for a 30-year. So So it's not twice as much payment,
Right.
even though you pay it off in half the time. But here's the big difference right here. Look at how much interest you pay with a 30-year mortgage. So you're going to pay $169,000 in interest. Just interest over the life of that loan versus $66,000, which means if you go with the 15-year mortgage, you have an interest savings of $102,716 in this example. So part of paying off your mortgage quicker is to make sure you're in the right mortgage.
That's exactly right. That's a big difference in interest payments.
That's right. So as we're giving more helpful tips of how to pay off your mortgage, now when does it make sense to actually refinance? So if you're already in a 30-year mortgage, but you've paid, you're on the latter half of that, and you've already been paying it for 15 years, maybe it doesn't make sense to pay off your mortgage. So we kind of give some general rule of thumbs here that if you're within the first 10 years of a 30-year mortgage, then it may make sense to refinance to a 10 or 15-year mortgage. And at the same time, if the current interest rates are 1.5% lower than your current mortgage rate, that could help as well. And if you're paying PMI, which is property mortgage insurance, which you can eliminate that if you're below the 80% loan to value. And we touched more on that on the how to buy a house video, so you want to reference that. So that's one tip. The other thing is you want to focus on paying extra principal payments. A lot of times the people will go to their bank and they'll kind of connect them to paying a payment every 2 weeks so that they pay one extra payment a year, or they make an extra payment here and there. You have to switch that mentality from that to as much money as you have left over in your budget after you're contributing to reach your financial freedom. However much extra you have left over, put all of that amount to paying down principal every month. And if you focus on doing that, you could pay off your mortgage quicker. And I'm going to show you kind of how that works here in a little bit on the amortization schedule, which brings us to the next point: how to read the amortization schedule. This sounds kind of nerdy and a complicated form, but it's really important to learn this, because the big thing, as we see here with an amortization schedule, is that, and this is a 30-year example that we're looking at, but look at this column that says interest. Okay, and see, this is the same mortgage, $270,000 over 30 years. Your payments year one for the whole year are $14,549. But of that, $9,367 goes to interest. Only $5,000 goes to principal. And then as you move down, the years, as you continue to pay it down, you can see your interest rate goes down. Excuse me, not your interest rate, but the amount of dollars that are going towards the interest goes down. So, if you understand that, then what that means is the more money that you can put down towards your principal sooner in the mortgage. Let me erase these marks because I'm going to show you an example here. If you were to, if you had a little bit of extra money, let's say you got a bonus, or let's say you had some mutual funds that are in a non-retirement account, or you have access, some savings, some CDs, something that you just had some extra, maybe just around $10,000. And if you were early on in this 30-year mortgage and you paid $10,000 to this mortgage, let's look at what happens. Okay, so if in the beginning of year one, just to follow this example here, you had an extra $10,000 that you can put to this mortgage. Now remember, you started off with this mortgage debt of $270,000 at the beginning of year one. By putting that $10,000 and change into that mortgage, what you do here is you've now gone from year one all the way to year 3, so you've knocked off 2 years. Okay, so you've taken your principal down from $270 down to $259,452. What that does, though, if you can see how much you paid per year in those first 2 years, you paid almost $30,000 in payments. So now you won't have to make those $30,000 in payments, which means you now save $18,550. So you put in about approximately $10,000 to your principal, you saved $18,550 in interest.
That's a good ROI.
And you knocked out 2 years in your mortgage. So rather than just making extra payments, if you have those lump sums of money that you can put directly to principal, especially the early on, the further down this amortization scale you can get. And now look at your payments. Your payments are going more towards principal and less to interest because you've gone further down the amortization schedule.
That's critical to understand. If you do make these extra payments, you have to be intentional sometimes about letting your mortgage company know you want this applied to principal.
Right.
Because what some mortgage companies will do, they'll just say, oh, these are the next 5 payments, okay, and they didn't change your schedule at all, and they have still applied, 60, 70% of this money towards interest, versus applying to principal, because when you apply to principal, it does what you did, was of re-amortizing, basically lowering the interest.
That's exactly right, and that happened to me. I literally put $10,000 of paying down principal, and I wrote a letter. It was 1 sentence long, and it said, apply this entire $10,000 to the principal. And then I check with my bank account after the check deposited, and I look, and they didn't apply it at all principal. And they didn't even do anything I asked. They applied like half of it to principal, and then they paid 2 payments. I'm like, what did you do that for? That doesn't make any sense. So, as Paul was saying, always check with your bank account, check to make sure they applied it all to principal. You just want to confirm, because sometimes they don't always
mortgage statement account.
That's right.
Holds your mortgage.
That's exactly right.
So understand that the goal of this is to really be able to position yourself to be financially free, to have peace of mind, to maximize your dollars, to minimize the amount of money that you're paying in interest to someone else. You work hard for your money. It's a shame that one of our biggest assets can also be one of our biggest deterrents in reaching financial freedom. That and cars, and we're going to talk about those in different videos, how to buy a house, how to buy a car. But if you can understand the amortization schedule, the dynamics, really be intentional about paying this down, it can make a huge impact on your financial freedom and the time it takes for you to attain it.
Yeah, and we do have multiple calculators, so be checking into AllGen Academy to see different calculators of how kind of to pay off your loan quicker or compare mortgages. There's all different types of tools we're going to give you, or that we've given you to be able to help you get through these. As
you've heard us say, financial freedom, okay, we really stress, or cannot stress enough, that paying off your home and entering the stage of financial freedom without owing your home, which not everybody does, knowing that as long as you pay your taxes and insurance, no one can kick you out of your house. That is financial freedom. That's financial peace.
Of mind,
So thanks for listening. Talk to you soon.